Welcome to the Investor Summit Green Room, the behind-the-scenes podcast where we bring you informal one-to-one interviews and panel discussions with fund managers, city professionals and financial journalists. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. Today we welcome the influential Simon French, Chief Economist and Head of Research at Panmure Liberum, the largest advisor to quoted companies in the UK. Simon spent a dozen years as an economic advisor in the UK civil service, working at Treasury and the Cabinet Office and the Department of Work and Pensions, and for a decade has written a fortnightly economics column in The Times. We are delighted to have you in the Green Room, Simon. Welcome.
I'm delighted to be here. Thanks for having me, Donald.
No, really, it's fantastic to have you. To get people of your calibre is a treat. Now, I see you as an economic voice of reason in an increasingly polarised UK, Simon. Is that balanced view of yours something you learned during advising successive governments? Tell me all.
Yeah, a bit of both. It's both the experience I had at the start of my career working in an institution, the civil service, that had to be impartial in terms of its advisory function. But also it comes from a bit deeper than that in terms of I'm fascinated by data and the stories the data tells you. And I do think that leads you away from taking a polarised political view on any particular issue and really navigate back towards one of the things that one of the cabinet secretaries I worked under, the late Jeremy Hayward, talked about, which is what works. And the data will tell you in an applied setting what works in terms of policy, what works in terms of economic growth. And that tends to inform my writing, my research, how I try and deliver the message on UK and the global economy.
If you could briefly summarise your government career for us, please, just to give us a sense of what you've actually done and what you've achieved in your time.
Yeah, so began on the civil service fast stream back almost 25 years ago, working at DWP, the Department for Work and Pensions, working on labour market reforms, migration reforms, pension reforms. And then in the run-up to the global financial crisis and during the global financial crisis, I moved to the centre of government and the Cabinet Office. And that, in conjunction with my time in the Treasury, was actually to reform the operations of government, initially in terms of open data and transparency, and then later in terms of efficiency. This was the idea that the centre actually was living beyond its means, an accusation we continue to hear to this day, and actually putting data, putting public services into the public realm to make them more competitive, but also have transparency, reprocure contracts, digitise services. That was very much the second part of my career before I went to what was then Panmure Liberum.
But everything you do is data-driven, which is a joy, rather than just simply opining. You actually take it all back to the data.
Well, I hope so, because I think if you just a person with an opinion, you just like the guy down at the pub who, I strongly think this. Well, what's your basis for thinking of that? What's your model? It doesn't need to be, a multifaceted empirical model, but what do you think that, if you pull a policy lever over here, either in terms of incentives or in regulation, what do you think the reaction of agents in the economy might be? And that was policy analysis, the core of policy analysis in the civil service, whether you were talking about trying to encourage people back into the workplace, people to save more for retirement, or latterly to try and incentivise the government to be a better contracting agent, delivery of public services. You look at the data, you draw your conclusions on how agents in the economy will respond, and then ideally you can then evaluate and see whether your prior models is reflected in revealed behaviour. And then if you take that back to, or if you roll that forward to how you work or how I work with investors, well, they want to know how the economy will respond to the various geopolitical events that have been all too numerous, actually, in the 12 years I've been working in the city. So you take the initial stimulus, be it a war, be it a pandemic, be it a political ruction, and then you think about the transmission through financing conditions, through the demand for certain goods, the supply of certain goods, the inflationary backdrop, the interest rate backdrop, and come up with a model that tells you a story how on different asset classes will perform. It's actually one of the questions I get a lot is, how is it different working in the civil service, working with the city? They're actually remarkably similar. The only distinction I would draw is that ministers want you to be right all the time. I think investors want you to make them think in terms of your analysis. I've rarely been taken to task for being wrong in terms of my forecasts, but I have been challenged if there's nothing particularly original or unique or hasn't made the asset manager think.
And that switch from public service to the cut and thrust of the commercial world, how did that take place?
So one of the people I worked with, who I have to give an awful lot of credit for in the civil service, was a guy called Stephen Kelly. Stephen Kelly, who had previously been CEO of the software firm Micro Focus, and then he came into government and was tasked with being the government's chief operating officer. And I worked very closely with him. I was his chief of staff in my last role in the civil service. And his broker, when he'd been at Micro Focus, was Panmure Liberum. And so when he was coming to the end of his time in government and he was going back into the city, he went on to be CEO of Sage, currently CEO of Serata. He said, look, go out and get some experience on the other side of the aisle. You're an economist, yet you've only really engaged with 40% of the economy, the public sector. There's another 60% out there. Go and see it. So initially, I went on secondment to Panmure Liberum for 12 months. Well, 12 years later, I'm still there.
You liked it so much.
I did.
And how is Panmure Liberum different from the Treasury and from the Cabinet Office?
Well, your customer base is obviously very different. Asset managers and corporates versus ministers. But also, you're operating in a commercial environment, and it brings a level of discipline in terms of where you allocate your time. Time is scarce. What you choose to research, you need to think constantly about whether there is a market for it, a commercial market for it. So it's more of a commercial sales-based setting, which I find really quite engaging, because there's a more direct feedback loop on the quality of your work. Sometimes if you produce poor work in the civil service, you get sidelined and ignored. If you produce poor service in broking, in investment banking, you tend to get fired. So it's a more, it focuses the mind on ensuring that value is at the very forefront of the work that you're doing.
Let's talk American policy, American foreign policy.
Yes.
Okay, we've got Greenland. Let's go back a little bit. It's all happened very recently, I'm afraid. Greenland, NATO, and now the war in Iran. It's all pushing the UK, at least militarily, into a more integrated Europe, it would appear to me. Is that how you interpret recent geopolitics?
I think so. I think it's shown, and Mark Carney, former governor of the Bank of England, now Prime Minister of Canada, talked in Davos earlier this year about the middle powers, of which the UK sits squarely in that area, having to take, if you excuse the Brexitism, have to take back control of their energy security, their food security, their national security, having perhaps in the UK's case, in the European case, rather outsourced that to the United States since the end of the Cold War. So absolutely, does that mean that the UK, who probably, given its scale and its public finances, can't do it alone, probably needs to do it in partnership, a procurement partnership, a commercial partnership, a defence partnership with its European neighbours? Yes. Does that unpick some of the debating points that characterise Brexit? Quite possibly. But when the facts change, you change your opinion, or at least that's what I thought we used to do.
So what do closer ties with the EU actually mean to you, Simon? Presumably rejoining the customs union or the single market, presumably those are unthinkable. And at best, we need to align militarily. Discuss.
I think single market and customs union remains tricky because the UK tried, or certainly claimed to have tried, to cherry pick the elements of the freedoms that it wanted to engage with. So it didn't like free movement of workers, but remember Michel Barnier said you couldn't cherry pick certain aspects of that. Now, the big question mark for anybody looking to re-engage the debate over customs union and the single market is whether, with enough political water having passed under the bridge, with a different person in Downing Street than the more confrontational both Boris Johnson and Theresa May, whether there is a degree of trust that can be forged to actually maybe be able to do a degree of cherry picking, or whether events in Ukraine and Iran will change the negotiating position of European partners. So it's probably worth, through our diplomatic networks, kicking the tires on this one. But I tend to agree with you that the chance of success on those particular areas is limited. On defence, though, I think there is probably a more strategic partnership that can be done outside those four freedoms, and therefore you're not crossing some of the old red lines that were heavily discussed, heavily debated over during the Brexit process.
The Iran war has had a ceasefire, a 2-week ceasefire has been announced. So let's ask for your commentary on that.
Yep.
What impact will that have on interest rates and on bonds? Because that's an obvious kind of question for you.
So three things, and I'll come to the interest rate and bonds question at the very end. But first of all, there's a quote that I hope I've never used. I mean, maybe someone will find a time when I have, but it tends to get rolled out at situations like this, which is businesses like certainty. Never met a business that likes certainty, or if I haven't met one, I certainly have met lots of business leaders who go, well, certainty is not reasonable. It's reasonable to expect that. What they do like is predictability. So I'll slightly change the quote. Businesses like predictability. And the problem is, while we've got a ceasefire, how predictable was that ceasefire until late last night? Very, very unpredictable. Also, going forward, how long will it last? Those counterparties, the regime in Iran, the Trump-led White House, how predictable are those? So businesses are going to still struggle, even with a ceasefire, to get a predictable operating environment. And this is layered on to the impact of Liberation Day just over a year ago, where there was another level of unpredictability introduced into the global economic system. So you might get a ceasefire, but that lack of predictability does not go away. Those are known counterparties that we are stuck with, who business has to operate with. So I think that risk premium on all assets will persist even though there's a ceasefire. Then there's the inflationary impulse, and we're coming around to inflation, interest rates. Your Bloomberg terminal or other data providers are available might tell you that the oil price and interest rate expectations are starting to revert back to sort of pre-war levels. But the real economy doesn't work quite as instantaneously as those data feeds. The reality is there's impaired capacity for oil and gas supply from the Middle East. There is impaired supply of aluminium from the Middle East. There's damage to productive capacity that will take a while to rebuild, even if the Strait of Hormuz gets reopened, and we don't really know what the tariffing regime introduced by Iran and potentially Oman will be. So there's potentially quite a protracted inflationary impulse, even if the near-term disruption might diminish. Third and finally, I think it actually vindicates the fact that central banks have been biding their time. They haven't instantaneously reacted to this by raising interest rates. They've gone, well, actually, financial conditions around the world are tighter than they were in 2022, so we don't need to rush to raise interest rates. And so I think to some extent the pullback we've seen this morning in interest rate expectations. I mean, late last week, there were 3 interest rate cuts predicted for the UK, at least on the options market. I don't think economists were saying that, but the options market were. This morning, only 1. And that tells you that the kind of reassessment of the trade-off for the Bank of England will be reflected in the short end of the curve, with rallying prices on short-dated gilts and less expectations of the Bank of England having to respond to a sustained inflationary impulse.
So I'll move on to the advice that Panmure Liberum are actually giving their clients at the moment. So what kind of stuff are you saying to your clients? What are your colleagues saying to your clients? And what should retail investors be doing? Should we be hunting for bargains, sitting on our hands? What should we be up to?
Well, there's a couple of structural aspects, notwithstanding the cyclicality of geopolitical events. What are the 2 structural tenets that I would drive at? One, is that the UK equity market, publicly listed equity market, remains at a long-standing discount. It's been going more than a decade, or almost a decade now on from the Brexit vote. We think it's about a 20% mark-to-market discount versus equivalent companies on other indexes, most noticeably the US. That is an arbitrage opportunity. Now, there are reasons of liquidity, reasons of passive flows, why that might not close in its entirety, but we still think structurally that discount is too large. And by the way, the ongoing M&A ecosystem of public companies being taken private at significant premium does reinforce the idea that discount is real and therefore an opportunity for investors. That's number one. Number two, linked to AI, we haven't talked about AI in the first few 10, 15 minutes of this podcast. It's actually a shift from the returns available to labour towards returns available to capital. That really should be quite, if you like, reassuring for investors as to why, notwithstanding the geopolitical frictions, why capital is going to continue to sort of flood in and try and capture some of the economic rents being accrued, not just by the AI hyperscalers, but by some of the AI adjacent firms. And therefore, I'm actually quite an AI optimist in terms of productivity, earnings potential. And I think for investors, the opportunity to grab that remains very real. It's a reason to remain invested. The third aspect of this, of course, is the cyclical fluctuations on geopolitical headlines. I always think, yes, I wish I'd made up the sort of TACO acronym of Trump always chickens out. Robert Armstrong did a much better job of getting there first. But the reality is that we know, don't we, from the last 24 hours, that there still remains a point through which the US administration won't go in terms of the economic pain that it's prepared to put on its own electorate, its own economy. And I think that can be reassuring for investors that some of the rhetoric, which got quite extreme, we have to say, in the last 48 hours, isn't likely to be backed up by equivalent actions. And that's a reason, perhaps, to trade in and out of extremities of sentiment, because those extremities are not particularly stable.
So you've been very patient. Let me turn to your own particular policy interest.
Yeah.
And I would frame it as foreign policy is taking up a lot of Keir Starmer's bandwidth right now. Not necessarily what he wants to be looking at, though, because he really wants to be sorting out the UK economy. Otherwise, he's not going to win the next election. So he's in a spot. Now, according to you and your most recent research, we ration everything we need for a healthy economy: energy, land, capital. Yes. So where do the problems lie with that, Simon, as you see it? Let's unbundle it. Let's take energy first of all. In what way is energy rationed?
They're all political problems. So these aren't economic problems. For a long time, again, and probably the second time in this interview, I'll talk about misnomers. We've had a productivity puzzle, have we? Mm-hmm. I don't think it's a productivity puzzle at all. It's not puzzling. If you ration key factors of production, you reduce the supply, you raise the price, you introduce inflation, you reduce output. I mean, that's pretty much what you learn in the first week of Econ 101. So it's not a puzzle at all. And so the UK, having, by any benchmarked analysis, and in the note you kindly reference, I benchmarked the UK across those three factors of production versus the G7, the G20. And I'll give you some data points. We have moved in 2004 from having an equivalent industrial electricity price to the US and the broader IEA to the most expensive in the IEA over the last 22 years, and actually 4 times the electricity price of the United States. How do we think we're going to get growth and productivity into the economy when we've done that? So that's the most obvious one in energy. Some of that is linked to net zero, but it's not all linked to net zero. It's also linked to a long-standing failure of building stable nuclear baseload, for example, an accelerated removal of coal-fired power, a restriction on licensing of new North Sea oil and gas development, and a very, very penal tax system. So again, by constraining the supply side, you pushed up the cost. That's in energy. In land, for 40 years in the UK.
I'm going to stop you there.
Go on.
What's the solution?
Oh, I mean, the solution is pretty clear. It's being less ideological on particular types. I hate the idea of us, we're pro-nuclear or we're pro-solar or we're pro-wind or we're pro-oil and gas. Be pro them all. Flood the space with capacity and you get prices down. And people might say, well, that's a very inefficient use of capital. Well, let the private sector decide. Let shareholders decide whether they want to allocate that capital to North Sea oil and gas developers or to nuclear developers. If you make the operating environment such that they can make decent returns, they will allocate that capital, they will flood it with capacity, and that will bring the prices down as sure as night follows day.
Is it just social media which is so binary in their choices, or are...
I think it's too easy to just blame it on social media. I mean, look, I've written, as you very kindly said in the introduction, this column in the Times for more than 10 years now, and some of them inevitably age less well than others. But one of the things that I wrote at probably peak ESG times in about 2021 before the Ukraine war was that I felt that ESG needed to go through a second phase of growing up. It had to mature. It had to recognize that a kind of animal farm, 2 legs bad, 4 legs good, sort of the aggregation of things like energy, things like defense companies needed to evolve with the real politics. Now, I didn't know the Ukraine war was coming. I didn't know the events in Iran was coming. I didn't know Trump would, retake the White House for a second term. But I think ESG has gone through that. And one of the reasons why energy, particularly, has been under-resourced in terms of capital has been the fact that ESG effectively made it impossible for large quantities of the institutional investor base to back large parts of the energy ecosystem. And that can't be right if you want to generate growth and productivity in the economy.
That's a very good point you make there. How do we ration land? Tell us all.
Planning. The Town and Planning Act has a lot to answer for. The UK has for 40 years built houses at a ratio of about half the G7 average. If you compound that year on year on year, you've got a structural gap of the capacity that is required for the UK population. Now, I understand why, because this is individually rational, that if you're already a homeowner, you want to restrict planning to both raise your asset price and retain the neighbourhood or the reduced urban density of your neighbourhood. But there's an economic cost for successive generations in terms of the cost of their disposable income or the amount of their income that goes on housing costs. You're seeing rents go up, you're seeing the cost of housing gone up to ratios that are inconsistent with their long-term averages. So again, it's relatively simple. And the government, to be fair, have made the right noises in this regard, which is to deregulate the planning system. The problem is, I think what they give with one hand in terms of reducing costs and frictions and restrictiveness on planning, they've perhaps introduced elsewhere in terms of the planning process of slowing it down and introducing new requirements. So I think there is with my old civil service hat on, there's a coordination function required. Are we actually going to make it more permissible to develop UK residential property? Because the spillover effect is geographical mobility, it's labour mobility, it's higher disposable incomes, even notwithstanding the first order impact of higher construction.
Will the government be capable of achieving those reforms?
I think it's easier for a Labour government to do it than a Conservative government. I think if you look at the setup of their constituencies and the constituencies they think they can win at election in 2029, more urban constituencies, less rural constituencies, tends to be that rural areas are more anti-planning reform than urban areas. Look, it's not easy for any government, but I think it's slightly easier for this government to do. But the proof is always in the pudding, and we've had if you excuse the butchered metaphor, very few desserts over the last 40 years.
And the rationing of capital?
That's the one for which this audience, the investors, probably are most aware of. There has been, since the early 1990s, a de-risking of the UK pensions market, de-risking away from both equities, but also UK equities more particularly. And there's lots of analysis on this carried out by both my former employer, the DWP, but also, the Capital Markets Industry Task Force. This de-equitization, partly it has to be said, because of the maturing legacy defined benefit pension schemes, workplace pension schemes in the UK had. And to some extent that rationing will, particularly to to risk assets will start to unwind as we move away from legacy DB schemes towards workplace DC schemes, which have more of a equity mindset, more of a risk asset mindset. But it's been painfully slow. And also we've rolled back over the last 30 years. Sorry if this is a bit of a history lesson in terms of capital markets reforms, but we've removed some of the inbuilt incentives to own domestic equity, or at least cite that equity or that capital in the UK. If you think about Nigel Lawson introducing the personal equity plan in the mid-1980s, there was a requirement to have 50% of the underlying assets invested in the UK. When the PEP got replaced by the Stocks and Shares ISA, that geographical requirement was removed. So that removed the incentive to own domestic equity. Similarly, in terms of the dividend tax credit abolition in the late 1990s, that removed the incentive for institutional pension funds to own UK dividend payers. And all of that has accelerated the allocation away from the UK towards other markets. Now, standing right back, people might say, well, that's been great because those other markets have performed better than the UK market over that time horizon. But there is a chicken and egg element to all of this, which is if you don't have the capital, valuations are lower, therefore you underperform, therefore you underallocate in a doom loop. This is the opportunity set for government. If you tweaked some of the tax incentives, you potentially get the doom loop going in the reverse, a virtuous cycle where you get valuations improving, you get issuance, you get performance, you get reallocation. I've tried very hard with government to get them to listen to this. Tentative steps, I would say, but nothing that looks like a fundamental reassessment of the incentive to allocate capital to the UK economy, with a positive spillover that lowers the cost of capital for UK growth companies, which of course we all want from an economic growth standpoint.
So capital markets reforms, encouraged by that capital markets working group that you mentioned there, they have been taking place, doing good work, but you seem to be saying not sufficient yet, not enough.
Well, I think most of the focus has been on private assets, private credit, private equity, infrastructure assets. That's the Mansion House Accord and the Mansion House Compact. Yes, AIM shares are eligible, but most of the allocation that I've seen has been towards those unlisted assets. Very little towards public markets. Yes, there was a bit in the last budget around a stamp duty exemption for new issuance in their first 3 years. That was a welcome development, but it was slightly sort of subscale.
You're kind, because it is very subscale.
It's very subscale.
Small part of a much bigger problem.
But stamp duty is, both in the property market and the equity market, it's a significant friction, significant cost friction, and more large companies are, large institutions are circumnavigating that. So it's a burning platform of a tax base. There's an opportunity for government to sweep that away and probably be relatively fiscally neutral in terms of the capital gains receipts that it would accrue from all of that, but also going back to that Lawsonian view of it's fine to incentivize through the tax system incentivizing to your domestic economy, because there are two sides of the equation. There's the investor return, but there is also the cost of capital for your industrial base. And I think we have not seen those as two parts of the equation for a long time, and we need to reassess that. And that analysis has been something I've been trying to share quite widely over recent years. Those,
therefore, are resolvable, would you say?
Absolutely. I mean, one of the reasons why I'm not a tub-thumping Remainer, but why I sit on the Remain side of the equation is that most of the economic problems the UK faces in terms of real household disposable income growth, GDP per capita growth, productivity growth, are resolvable by things that were sovereign to the UK as a member of the EU, and therefore getting out of the EU was not necessary to make those policy changes.
Very good point. So my final question, Simon. You'll be glad to hear. You spoke at the Investor Summit last August. Thank you very much for coming along. We thoroughly enjoyed having you. You made a convincing case for a sort of middle ground UK economy, really. Yep. Have those economic headwinds that we were experiencing then, have they got worse now rather than better? So there's your catch-all. You can summarise all your thoughts for me now.
Yeah, so I think the point that I made at the Investor Summit, which I've built on since, is the UK, despite all the challenges, and we've talked about a lot of them, geopolitically, Brexit, domestic policy choices, it's a very resilient economy. very, very resilient. I mean, it makes you wonder if you had tailwinds rather than headwinds, what was possible. But that resilience shouldn't be completely ignored. And it was the point I was trying to make at the summit, which is notwithstanding all of those, what I think are policy missteps, geopolitical shocks, the UK's pipeline of intellectual property coming out of a globally very relevant and very high quality university system still is something the investors want to buy into. The valuation story that emerged after Brexit has remained quite persistent, is still an opportunity to go and make outsized returns should policy and sentiment start to change. I was making the argument that resilience and the valuation opportunity was the compelling case for the UK economy. I think I concluded my presentations by saying we needed a catalyst for that to happen. I've hoped for a long time that would be, if you like, political bravery for embracing some of those difficult trade-offs. I have to say this government has been something of a disappointment in that regard, of not being brave enough on some of those big areas. It's been quite ponderous, but I retain the hope.
Simon French, thank you so much for joining us in the Green Room studio today. It has been a real pleasure. Thank you. And for sharing your economic insights with Investor Summit listeners. Thank you very much indeed. Once again, I'm with the man behind the Investor Summit, Sam Bell, CEO at Copia and Summit co-founder. Sam is the more experienced private investor, and I'm learning the hard way. We're here to discuss stocks which we think are investable and to discuss how geopolitics have been muddying the waters. None of this is investment advice, of course. Greetings, Sam. So let me ask you, what have you been up to over the Easter weekend? Has it been a nice break for you and the family?
Oh, always great to have a few days off and then the weather to go with it as well. Been so lucky the last few days.
Brilliant. But plenty happening, to be sure. Yes, I was working on my Simon French questions. He was a terrific interviewee and very interesting. Mm-hmm. Now, he has his own philosophy about the supply side constraints of energy, land, and capital.
Yes.
So what did you make of his energy constraint thoughts?
I mean, Simon's great. I mean, the fact he's a true economist, refuses to be tribal, will say stuff that make people on both sides of the aisle feel uncomfortable about. That's really good. And his framing of, I think he was talking about UK productivity and how it's, lots of people call it, there's no explanation for it, but actually you only need to take a slight step back and you can see it's very structural, that we're tying up land and capital and really tying our own hands behind our backs when it comes to this stuff.
Exactly so. He described it as Econo 1, another week 1 economics. So he says, go back to the very basic principles of economics, and it's not so hard.
Yeah, but blindingly obvious, some of it.
A statement of the bleeding obvious. Yes, indeed.
But whether anyone will have the political will to change any of it.
But North Sea oil, he mentioned North Sea oil. So we all agree on this, don't we?
Oh, yeah. I mean, our stance on that is insane any day of the week, but to maintain that stance and double down on it, even in the midst of a global energy crisis caused by the Iran war, I mean, how can you explain that? Something's got to give eventually. I think one of the stats that stood out, again, that Simon just described, 2004, UK energy prices were on par with the US. Now our energy costs 4 times as much. So it's worth reiterating that. Again, that's another way we're tying our own feet together when we're trying to build up our economy.
Yes. And there's no way around that. The economy will never grow if we're paying such high energy costs.
No. And you already said, of course, we run our ticker site. So I'm sitting reading the RNS every morning. I've noted down a few examples here. And you're already seeing this. I mean, companies have been complaining about it somewhat for years, but really, really exacerbated in the past 4 to 6 weeks since everything in Iran kicked off. And it's not always the things you would expect either. So, of course, big example would be someone like Goodwin. So, manufacturing company here in Stoke, but where they produce valves for LNG tankers and things that are used in Qatar, I think they took a hit of something like 40%, and they put out a profit warning one morning. That's the obvious stuff. But then you've got all these second order effects. So was one Helix? Yeah, Helix exploration. All three of Qatar's helium plants go offline because it's all been attacked. Spot helium prices are suddenly up 35 to 50% in a week. And that's the kind of stuff you won't see necessarily on the front page. There's so many industrial uses of helium. So you've got second order and third order effects coming down the line. Medical uses as well, of course, for helium. So even with this morning's news that Strait's back open, 2-week ceasefire, and who knows how long that will last, I think we're in for a painful few months because of this stuff.
All these problems have been baked into the UK economy, unfortunately.
Yeah, I mean, there's a much smaller, sort of a small cap Myriad Advertising last week before, nothing to do with oil and gas, but they're finding their clients are pausing projects because of, the global security situation. So all kinds of businesses now are being affected by this kind of thing.
Okay, so drawing a line under the all that negativity, let's talk about glorious news. The Investor Summit itself is back. 18th of September is a date for the diary.
Yep, and we've already got some good, I won't trail names just yet, but also got some good CEOs and fund managers lined up that are actually quite relevant to this conversation we're having now. And I'm sure, sadly, in September will still be very relevant. The issues the UK is facing and on the energy side of things.
The user base has been very supportive of us, but also the fund managers and the economists, Simon French, that we spoke to and who spoke at the summit, are actually supporting us, and no doubt quite a few of them will be back again.
Yeah, I mean, it's wonderful to put tickets on sale and see handfuls of them fly off the shelves basically in the first 24 hours. So I'm glad people are keen to come back.
And well worth mentioning that the top team is back. There's there's Pete Higgins, the co-founders, and backed up by
our Copia team.
Our Copia team. So what can we look forward to? What will this year be like in terms? Will it be any different or just more of the same?
More of the same, with a few additions. Yeah, a few tweaks. I mean, it's in a different month for a start, but improve our delegate lounge as well. People did say to us, as much as they enjoyed listening to these really interesting fund managers and CEOs, they also come for the networking and getting to know what other investors are doing and, talking about their favourite stocks with people.
It's a huge part of it.
Yeah, so we'll make sure we can facilitate that well, certainly.
Yes. So delegate and companies. We're going to have a track full of companies. So rather a little bit more like Mellow, rather than being quite as independent as we were in the first instance.
Yeah, I think we went heavy on the education angle in the first year, and we're certainly going to stick with that. But the beauty of having a multi-track event is, people can pick and choose what they want to listen to. It means we can really, really pack it with content.
Great. And what's happening with your portfolio at the moment, Sam?
Well, we seem to talk about this one every week, every month. But Greatland again, great news out this morning. Nice big MRE last week.
Phenomenal.
Good production results. Tie that in with the fact the Strait reopened this morning and gold has, over the past few weeks, become less of a risk asset. So it's now reversed and gone higher this morning, thankfully.
Gold rose this morning, didn't it?
Yeah. So triple whammy for that particular stock.
Well, that's great news. Greatland Resources is the gift that keeps on giving. Even when the share price is going down, it is never dull.
No. And those guys are coming over next week, aren't they? So
that's right, 16th. So we've got the Greatland Resources Town Hall, which we put on their behalf. So that's a live stream Q&A at 5:00, and then at 6:30 we've got
actually, it's just such a. I mean, it's fantastic that a CEO is willing to do that, fly from Australia and talk directly to his investors. But it's also a great example of retail appetite. to have 200 people physically turn up to sit and listen to a CEO talk about his company.
But it's an example of how to, I think, simply because Sean Day, the managing director at Greatland, he really appreciates that retail audience has been with them through the difficult years as well as the now
and they've
good
been rewarded for doing so.
So I think he, perhaps uniquely, he sees the importance of retail.
But it would be nice to see
investor
more and more people doing it.
I wouldn't just. Okay. And you've mentioned gold price decoupling and stop being a safe haven. Why do you think gold decoupled and stopped being a safe haven, Sam?
One theory would be, you pull it back to the Middle East goings on again. The income of a lot of these Middle Eastern countries, suddenly, their cash flows, the taps have quite literally been turned off. Something they sit on a lot of. It's gold holdings. You've seen a couple of countries, actually quite notably, selling off gold holdings.
Yes, Turkey was selling, wasn't it?
Yeah, exactly. I forget who it was. May have been France even, that sold what they had in New York to rebuy this side.
I think that's more structural selling.
Yeah,
though. The quality of the gold bars weren't quite what they ought to be.
A bit of repatriation.
And a bit of repatriation, yes, which does fit into our overall theme.
Yeah,
yes, we don't live in the safe world.
It's a different world than it was just a month ago.
Different world than it was just a few months ago. Well, Sam, I'm going to call it a draw there, call it a line there. Thank you very much for joining me. We're out of time now. Our next interview will be a live stream Q&A with Sean Day, Managing Director at Greatland Resources. That's the 16th of April. And links to register for both events are currently available on the www.ticker.app website. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. This Investor Summit Green Room podcast is produced by Copia, creators of investor events, video, and websites. If you've enjoyed our monthly podcast, please do subscribe on YouTube or follow us on your own podcast platform. And of course, we'd love to hear from you.